The Michigan 5-year inflation expectations is a key economic indicator that measures the inflation expectations of consumers in the U.S. over the next 5 years. This data is collected by the University of Michigan as part of its monthly Consumer Sentiment Index survey. The Michigan 5-year inflation expectations reflects how consumers perceive the future trajectory of prices, which can influence their economic decisions, such as spending, saving, and investment behaviors. The Michigan 5-year inflation expectations data is based on a survey of consumers, asking them what they believe inflation will be over the next 5 years. It serves as a measure of long-term inflation expectations, which can influence both consumer and business behavior. The indicator is particularly valuable because it offers insights into consumer sentiment regarding the economy, which can impact inflationary pressures in the future. The survey is part of the University of Michigan's Surveys of Consumers, a monthly report that provides insights into consumer sentiment, expectations, and attitudes. Respondents are asked to forecast inflation for the next 5 years, which provides a long-term view of consumer expectations compared to shorter-term inflation expectations. Inflation expectations influence consumer decisions. If people expect prices to rise significantly, they may be more inclined to spend quickly before prices increase further, or they may adjust their savings habits. This can contribute to actual inflation in the economy. The Federal Reserve and other central banks pay close attention to inflation expectations. If long-term expectations are stable and near the central bank's target, it suggests that consumers and businesses have confidence that inflation will remain under control. On the other hand, if inflation expectations rise significantly, it may prompt the central bank to take action, such as increasing interest rates to prevent inflation from becoming unanchored. The Michigan 5-year inflation expectations also helps economists compare how actual inflation compares to expected inflation. If actual inflation runs persistently above expected inflation, it may signal a need for policy adjustments. A stable or moderate level of inflation expectations, typically around 2 to 3% annually, is generally seen as healthy and consistent with a growing economy. A sharp increase in inflation expectations could indicate rising concerns among consumers about the future cost of living, potentially reflecting worries about supply chain disruptions, rising wages, or government fiscal policies. A decrease in long-term inflation expectations may indicate consumer confidence in future price stability or expectations of deflation. The February Michigan 5-year inflation expectations report will be particularly important in assessing how consumers are reacting to current economic conditions, such as wage growth, energy prices, and housing costs. Analysts and policymakers will look for shifts in these expectations, especially in the context of the Federal Reserve's monetary policy and its efforts to curb inflation through interest rate hikes or other actions. If consumers expect inflation to remain elevated over the next 5 years, this may influence central bank actions and lead to tighter monetary policy, such as higher interest rates, to anchor inflation expectations. The Federal Reserve uses inflation expectations to guide its monetary policy. Stable and well-anchored inflation expectations help the Fed maintain economic stability, while a significant increase in expectations may force the central bank to act more aggressively to control inflation. Investors monitor the Michigan 5-year inflation expectations because changes in inflation expectations can affect interest rates, bond yields, and stock market behavior. If inflation expectations rise significantly, interest rates may increase, which can lower bond prices and affect the valuation of stocks. If consumers expect prices to rise in the future, they may adjust their purchasing patterns, which can influence overall demand in the economy. Strong expectations of inflation could lead to increased spending in the short term, contributing to demand-driven inflation. Historically, the Michigan 5-year inflation expectations has remained relatively stable, typically fluctuating around the 2 to 3% range. However, during periods of economic turmoil, inflation expectations may shift significantly. In recent years, particularly post-pandemic, inflation expectations have been volatile, reflecting rising prices due to supply chain disruptions, labor shortages, and fiscal stimulus programs. The Michigan 5-year inflation expectations is an important gauge of consumer sentiment about future inflation, influencing consumer behavior and shaping monetary policy decisions. Analysts and policymakers closely monitor these expectations to understand how consumers perceive the economy's future price levels. The February report provides valuable insight into current economic conditions, offering a sense of where inflation expectations are heading and how they may influence future economic growth, interest rates, and financial markets.